Assalamualaikum warahmatullahi wabarakatuh and very good afternoon to all. So now let's discuss on the chapter 5, which is more details on how to evaluate the financial performance of a venture. Basically, the aims of this chapter is to understand important financial performance measures and their uses by life cycle stage. And you should be able to describe how financial ratios are used to monitor a venture's performance, and then identify specific cash burns, rates, measures, and liquidity ratios, and explain how they are calculated and used by an entrepreneur, and then identify and describe the use and value of conversion period ratios to the entrepreneur, and after that identify specific leverage ratios and explain their usage by lenders and creditors, and identify and describe these measures of profitability and efficiency that are important to the entrepreneur and equity investors. And finally, this chapter will describe limitations when using financial ratios. Financial performance can be measured based on the life cycle of the venture. Okay, as we have discussed previously, there are three stages of life cycle for each venture. The first one is a development and startup stage, and second one survival stage, and after that rapid growth stage. And here the types of financings, basically we have also discussed for the startup. So they basically need to have a seed financing and startup financing. For the survival stage, it is a first round financing if they need to get more sources of funds, so they can apply for first round of financings. After that, for the rapid growth stage, they can go for the second round of financing, or called as mezzanine and liquidity stage financing. And to measure the financial performance of the venture, okay, basically for the startup stages, the financial performance is measured through cash burn rates and liquidity ratios, and also conversion period ratios. Meanwhile, for the survival stage, basically the performance is measured by cash burn, liquidity and conversion ratios, leverage ratios, and profitability and efficiency ratios, because at this stage the venture can have have started to receive or to earn a profit from the business. And for this is the stable stage of the venture. Basically the financial ratios that involve, okay, to measure the financial performance of the venture is leverage ratios and profitability and efficiency ratios. Okay, and then for the users of financial ratios and measures, who are the parties that interested to know the financial performance of the venture? For the first cycle, the entrepreneur itself, okay, the owner of the business, and then business angels. Okay, for maybe the external investors, if they want to invest into that venture, they can they want to look at the financial performance of the business. And after that, venture capitalists. Okay, and then for the second stage of the venture, the party that interested to know the financial performance is entrepreneur, financial business angels, and also venture capitalists and commercial banks. Okay, perhaps the business or the entrepreneur wanted to seek for the first round of financing. That is why the financial institutions like commercial banks will observe, and then will assess their financials performance, okay, through leverage ratios, profitability, if the business is confident enough and that have received profit for a certain period of time, okay, during time, and then maybe the commercial banks easy to approve the financing. And then after that, the stable stage, basically the entrepreneur business angels, and also venture capitalists, or the investors, commercial banks, and investment bankers. Okay, because of maybe during this stage they want to seek for the second round of financings, and also investments from the business angels, from the venture capitalists. Okay, okay, that's for okay the who are the parties that are interested to know the financial performance of a venture. Okay, basically there are four types of financial performance measurement. Okay, the first one, the very famous and the very usually the entrepreneur uh, use financial ratios to measure their financial performance. What is financial ratios? Financial ratios is the to show the relationship between two or more financial variables. Okay, using a ratio. So there are financial variables, and then we can, based on certain equation, we can measure the financial performance of the venture through uh, various ratios. Okay, like ROE, return on equity, ROA, return on asset. Okay, and then the second one is trend analysis, used to examine a venture's performance over times. Okay, in this case we want to seek this analysis can observe the trend or the performance of the venture. Okay, for example, through a period of 1 year or 5 years, 10 years, what are the analysis the trend of the performance. And then after that, cross-sectional analysis used to compare a venture's performance against another firm at the same point in time, because it is cross-sectional. So we want to compare the performance of our own business with other competitors in the industry. Okay, or we want to compare two ventures at the same time. Okay, and after that, industry comparable analysis, it is from bigger view, used to compare a venture's performance against the average performance in the same industry. Okay, so from a small scope, the internal one, this one two, the measurement here is internal measure for financial performance, and this one is external measure of financial performance, cross-sectional and industry. Okay. There are three sources to measure financial performance of the venture, which are income statement, balance sheet, and statement of cash flow. Okay, so in the example MPC income statement here, okay, to compare 2 years, 2009 and 2010, for the income statements, basically these are the format starting from the net sales of the goods sold. Okay, so the net sales for the MPC, for example, in 2009 is 438,000, and in 2010 is 575,000. Okay, and then minus with cost of goods sold, and then they will get we can get a gross profit and minus all the expenses, and this one earning before tax and minus interest expense. Interest expense is interest for the financing that they receive, and this one income before tax. Okay, even you can see here, even in 2009 the net sales is lower than the 2010, but the income before tax is higher than 2010. Okay, and then minus income tax, and then they will get a net income. So from here we can see from 2009 2010 the incomes for the company is decreasing from 21,000 to 19,000. Okay, after that, we check the balance sheet of the MPC. So balance sheet is the equation for balance sheets is asset equal to liabilities plus equity. So the upper part here is asset and below part is liability and equity for the company. So asset here we have a cash and marketable securities, receivable, inventories, and then total current asset. Usually it started from current asset and after that fixed asset like plants and equipment and net plant and equipment. So total asset, current asset plus fixed asset here. Okay, so from 2008 until 2010, okay, the highest asset for the company is in 2010, meaning that the total asset of the company increasing since 2008. And the liabilities and equity, payables, liability, short-term bank loan, liability. So from current liability to fixed liability, and then after that equity or capital of the business. So total current liabilities 95,000 2008, and then 204 2010. So the liabilities of the company also increase. And then long-term debt, this one a fixed liability or long-term liability, long-term debt. Maybe the company receive a long-term financings from the bank. Okay, so in 2008 100k, in 2009 the balance is 90k, 2010 and is 80,000. Okay, meaning that their long-term debt is decreasing. So it is normal, unless the company in 2009 increase or apply the second financing from other banks, okay, so that they will have an increase in long-term liability or long-term financings, for example. And after that, owner's equity. So total liabilities and equity must equal to total asset. Okay, total asset of the company. Yeah. Okay, next is statements of cash flow. Statement of cash flow is very important. It represents the cash that the company have. Okay, they need to have a very strong cash flow in their business. Okay, so these are the format for the statement of cash flow. Okay, it started with a net income that they receive, and then plus depreciation. Okay, and then increase in receivable. When there is increase in receivable, meaning that their cash is reducing. That is why we can see here it is deficit, minus. Increase in inventories. They have to withdraw their cash to pay the inventories, but the total inventories increase. And then increase in payable. So payable is the company debt, so that is why it's plus 10,000, meaning to say their cash increase lah, because they ought to have financings or cash from external, from other parties. Okay, so increasing also in 2010. Increase in accrued liabilities, same lah, 1,000 and 1,000. Okay. Okay, so net cash flow from operation. So these are all related items that related to the operations. Operation, what is item for operation is the items that is used to run the business, to operate their business. So cash in 2009 is 6,000, but cash in 2010 is deficit and negative, meaning that the company do not have a good balance in their as a cash balance. So cash flow from investing activities, in case they have a invest and then they receive like a profit, cash profit, so they can add here. So increase in gross equipment, nothing, okay, in 2009. But increase in equipment is bought in 2010, so they have to withdraw money 50,000, okay, to buy equipment. Negative, so negative here means that they are basically this equipment is financed. This equipment is financed by the maybe other parties. Okay, the equipment is increased, but at the same time, they have to minus their cash. This is a debt lah. So cash flow and then net cash flow from investing activities. Why equipment is said to become invest under investing activities? Because this equipment is used to invest lah, to use to operate their business. So it say it is a investment for the company to buy equipment, but they bought the equipment with a debt. Okay, negative. And then cash flow from financing activities increase in short term bank loan. They receive loan from the bank and decrease in long term debt. They minus lah because they pay the long term debt they use. This one they receive money. Okay, net cash flow from financings. So net cash flow from financing is negative 6,000, and this one 2010 they receive cash from the bank, so they have a positive balance here. The net change excluding cash accounts, no change lah in the but this one they have a negative 5,000 change in net change excluding cash account. Okay. Okay. Okay, because of the net change is calculated based on net cash flow from investing activities negative 50,000 in 2010, and they receive 66,000 from the bank to pay for the equipment, and also they pay their long term debt. So the balance is 5,000 balance. Deficit, still deficit. They don't have enough money to pay all of that. All of this, the equipment and also the long-term debt. Okay, so beginning cash and marketable securities, 10,000. They have securities, and then same at the same time, beginning cash and marketable securities, and then ending cash and marketable securities is balance 10,000, and this one balance 5,000 after pay all the liabilities here, all the expenses here. For the long-term debt and also the equipment. So balance for the company. Okay. So marketable securities is securities for short-term securities that the company have. Yeah. Okay, let's discuss about the one of the items to measure financial performance of the venture. The first one is cash burn. What is cash burn? Cash burn is a cash a venture expend on its operating and financing expenses and its investment in asset. Cash a venture expenses on its operating and financing expenses and its investment asset. So cash that they have utilized to operate their business, including financing and investment. So cash burn rate is a cash burn for a fixed period of time. We use a rate lah for period of times. What are that cash that already burned. This is the formula to calculate the cash burns starting from the inventory, okay, that the company buy inventory, and then minus related expenses plus admin expenses plus marketing expenses plus R&D expense plus interest expense and change in prepaid expenses Okay, and then minus change in accrued liabilities plus change in payables plus capital investment plus tax. Okay, just to remind that what is cash burn? Cash, all cash that already burned to start the business. Okay, which including expenses, the inventory that the company or the venture buy, and also the financing expenses, the interest rate paid, and also the investment. So for the MPC for 2010, the cash burns is 606,000 K. Okay, then how about cash build? Cash build is the cash that is able to generate by the business. So the equation for cash build is net sales minus change in receivable. Okay, the sales that received by the venture or by the business minus all the debt that they give to their customer, so that the cash they are able to build in hand. How about cash build rate? Cash build rate is a cash build for a fixed period of times for a certain like a month. So how much the cash that able to generate by the venture for a month, for example. Okay, so net cash burns equals to cash burn minus cash build. Cash that already used for the operation, investment, and financing, because that financing, the money from the financing is used for the operation minus cash build. So the company can calculate what the net cash burn that they receive. So previous slide, net cash burn for the MPC is 606,000. 100,000 and then minus 545,000. So the net cash burn for the company for that month in particular is 61,000, because on that month they still able to generate some profit. Oh no, not some profit. They generate sales from the business. Okay, among important financial ratios is a liquidity ratios. Liquidity ratios indicate the ability of the venture to pay for the short-term liabilities when they come due. Okay, so the first ratio to measure the liquidity ratio of the venture is current ratio, which is average current asset, okay, divide by average current liabilities, the asset that they have and the liability that they hold. Okay, second one is quick ratio. Quick ratio is average current asset minus average inventories divide by average current liabilities. Okay. Next is net working capital, which is current asset minus current liabilities. Okay, so net working capital to total asset ratio equals to average current asset minus average current liabilities divide average total asset. Okay, let's have a summary of the measures that we have discussed previously. So we have discussed about cash burn, cash build, and then net cash burn, and the liquidity ratios, which are measured by current ratio, quick ratio, and net working capital to total asset ratio, or net working capital ratios. Okay. Okay, so based on the MPC example, between 2009 and 2010, so the cash burn for 2009 is lesser than 2010, but and then for 2009, the cash bill generated by the business is higher than the cash burn. Indicate a good it is a good indicator for the business, where if they able to generate a bill more than the cash burn, so that they will get a profit. But compared to 2010, the cash bill is lesser than the cash burn, so they are burning cash so that they are unable to generate profit. Okay, so the net cash burn is cash burn minus cash bill. Okay. So negative cash burn is indicate a good situations lah, rather than a bigger cash burn compared to the cash bill. And then for the liquidity ratios, basically it is measured by current ratio. What is the liquidity ratio? Liquidity ratio is present the ability of the business to pay for the current liabilities based on their current asset. Okay, for the liquidity ratios here, the higher rate of the liquidity is better, meaning that the ability of the business to liquidate their asset in order to meet their liability, the current liability. So we can see here, compared 2009 and 2010, 2009 is better than 2010, because 2010 the current ratio is 1.37 only. Okay, and then quick ratio for 2009 is better than 2010. Okay, and also same with net working capital. 2009 is better than 2010. This is the operating cycle of the business venture. First, starting from the cash that they have kept in terms that they receive, maybe from the capital or from payable. So the cash. So from the cash, they can buy materials, and then the materials will be used for work in a progress for the operations, and then finished goods. So after that, they sell the goods to the customer. So if they sold the goods in terms of uh, credit sales, so they will generate a receivable. Or if the goods sold is on cash, so they will receive a cash. So the cash will be used to buy materials again, and the cycles will be repeating. Okay. Okay, now let's discuss about conversion period ratios. What is the conversion period ratio? It indicates the average time it takes in days to convert certain current asset and current liability accounts into cash. Now, cash is more important than other things. So, this conversion period ratio is represent the ability of the company to convert their asset and their liabilities to generate a cash. Then operating cycle, time it takes to purchase, produce and sell the venture's products, plus the time needed to collect receivable if the sales are on credit. So cash conversion cycle, sum of the inventory to sell conversion period and the sales to cash conversion period less than the purchase to payment conversion period. If we can go back to the cycle, so the cash conversion cycle is basically the cycle to convert the cash. Okay, the sum of the inventory to sell conversion period. This one more about the period to convert the inventory to the work in progress, and to sell and purchase, purchase to payment conversion period. Okay, how to generate cash basically. Measuring conversions times, which is the inventory to sale conversion periods. So how to calculate the inventory to sale conversion period is average inventories divided by cost of goods sold divided by 1 year. Okay, this one based on yearly. Okay, we can get 112 or 113 days of the period of to convert the inventory to the sale. Okay. Okay, now how to calculate sale to cash conversion period. If we look at the operating cycle, okay, from the inventory, so it is go to the goods, okay, final goods, and then from the final goods, the business will sell the goods and will get sell. And then now how to measure the sale to cash out the to cash out the sale that they receive, either this one through receivable in case of the good is sold based on credit sale. So how to calculate it? Average receivable that they receive in a year divide by net sales, and then net sales divide by a year, days in a year, 365 days, so 57 days to convert the sale to the cash. So if they know that they need about 2 months to convert the credit sale to the cash, so they can expect or the plan uh, when they should buy the inventory, and when they will receive cash in order to produce more goods in future. Yeah. Okay, so and then now after they receive cash, or even if they do not have, if the business do not have cash but they still want to make a credit purchase, so how to calculate the conversion times of purchase to payment conversion period. So average payables plus average accrued liabilities, and divide by cost of goods sold, and divide by days in a year, 365 days. They have more than 2 months to convert their purchase to payment period, eh? Okay, so these are overall the cash conversion cycle from inventory to sale conversion period, and then plus sale to cash conversion period, and minus purchase to payment conversion. So overall, they need about 3 months for the whole cycles in order to make a profit for the business. The summary that we can make based on the MPC example, the conversion period ratio for the inventory to sale for 2009 is 105 days, and 2010 is 112 days. Okay, so I think the performance is the performance about 7 days. So for the business to enhance their efficiency, they have to reduce the conversion period. And then for the sale to cash, so also about 1 day delays, and purchase to payment, um, okay, in 2009, 77 days for to make a payment for their purchase, and 2010 76 is about plus and minor. Okay, not so much efficiency to pay the purchase. And then cash conversion cycle overall, 2009 84 days, 2010 93 days, delays longer. So what I can say here, the performance of MPC is not in a good they are not in but not perform well. Okay. Okay, let's proceed with leverage ratios. What is leverage ratio? It indicates the extent to which the venture is in debt and its ability to repay its debt obligations. Okay, leverage ratio. They are making a debt. So this ratio measures their ability to pay their debt obligations. So we have a loan principal amount, dollar amounts of borrowed, and interest, dollar amount paid on the loan, the interest paid on the loan. Okay, so the first ratio to measure the leverage ratio of a business is total debt to total asset ratio. So how to calculate it? Average total debt divided by average total asset. Second one is equity multiplier. It measures the amounts of a firm's assets that are financed by its shareholders by comparing total asset with total shareholders' equity. So in other words, the equity multiplier shows the percentage of assets that are financed or owned by the shareholders. Okay, so if we can see here, the equity multiplier is 2.58 times or 1 to. Okay, so uh, the the shareholders equity is 2.58 times over the total asset, the total asset owned by the business. Yeah. Okay, next is current liabilities to total debt ratio. It measures the average of current liabilities over the average of total debt. So in this example, 64.88% of the total debt of the company is consists of current liabilities. Okay, next is interest coverage ratio. It measures how many times a company can cover its current interest payment with its available earnings. Usually, it is calculated based on earning before tax divided by interest. So, in this case, there are 3 times of the ability of the company to pay the interest based on the earnings before tax. Okay, next is fixed charge coverage. It measures a firm's ability to cover its fixed charges, such as debt payments, interest expense, and equipment lease expense. It shows how well a company's earnings can cover its fixed expenses. So, based on earning before tax plus lease payments divided by interest plus lease payment plus debt repayments. Okay, 1 minus T. Based on the summary of the MPC example, we can see here the leverage ratio performance of the company is a good, meaning that the company is the ability of the company to pay their liability, okay, based on their asset is increasing, is a good condition. So we have a total debt, total asset, equity multiplier, current liabilities over total debt, and interest coverage, fixed charges coverage all increase in 2010 compared to 2009. Okay, next is the most significant or important part is to measure the profitability and efficiency of the financials of the firms lah. So we have a profitability ratios and we have efficiency ratios. What is profitability ratios? It indicates how if efficiently a venture control its expenses based on the profit that they receive, and efficiency ratios is indicates how efficiently a venture uses its asset in producing sales. One is to control the expenses, and the one is to use asset to produce a sale. The first indicator for profitability measure is gross profit margin, which is net sales minus cost of goods sold divided by net sale. Okay. The second one is operating profit margins, earning before tax divided by net sales. One is net profit margin, net profit divided by net sales. It's very straightforward. Okay, next is NOPAT, net operating profit after tax. It shows how well a company performed through its core operations net of taxes. So it's calculated based on earning before tax divided by net sales. Okay. In bracket 1 minus tax rate and divide by net sale. Okay, next is a sales to total asset ratio. The net sales that are received by the business divided by average total asset. It's basically to calculate the ratio of sales based on the asset that the company have. So how many times? In this example, 1.4 times of net sales over the total asset. It is a good. This is the common ratio that basically people measure to measure the profitability of the business, which is ROA, return on total asset, which is calculated by net profit divided by average total asset. Okay, net profit earned by the business, which divide by depends on the total asset given the total asset that the company have. So in this example, the net profit is 4.8% over the asset that the company have. The other measure of ROA is known as ROA model. The decompositions of ROA into the product of the net profit margin and the sales to the total asset ratio. So I think it's about the same, but the formula is quite different, which is net profit divided by sales times net sales divided by average total asset. Next is return on equity. Basically, ROE is ROE is concerned by the investor, where if they want to put sums of money or invest money into the venture, so they will calculate how much is the ROE for the business, return on equity, based on a certain amount of money, how much return that they can get. Okay, so how to calculate ROE is net incomes divided by average owner's equity. Okay, so in this case, ROE is a 12.5%. Okay, return. Overall, based on MPC example, the measurements for the profitability and efficiency of the business based on the list of the ratios here. For example, gross profit margin, we compare 2 years, 2009 and 2010. It indicates a low gross profit margin for the business. So all low operating profit margin, lower for the 2010, except sales to total asset, which is increasing for 2010. Okay, even return on owner's equity also decreasing. So in this case, MPC would face a hard time to get more investors to invest into their business. Okay, that's all for this chapter, about the measuring the financial performance of the business. So the financial performance can be measured or can be observed through the cash that the company hold, and also the ability to pay all the debt or the liability that they have, and also the ability to liquidate their asset or at that particular period of time, and finally their ability to make a profit out of the asset that they have, and then also out of the equity that they receive from the investors. Okay, so that's all. Thank you.